What are the most important questions that you should be asking when looking for a loan officer or a mortgage company? Hey everyone, it's Mortgage Mel and it's time for today's Mortgage Minute. So let's get right into it. The types of mortgages that are offered with regard to amortization schedule are 15, 20, and 30 year. And I would suggest that the 30 year is usually the most popular because it will glean the lowest payment possible as you're spreading your payments over 30 full years. Further, we have fixed rate mortgages and we have adjustable rate mortgages. A fixed rate mortgage is one where the rate stays exactly the same. So whenever you lock it in, and after you close, you'll be keeping that same rate for as long as you have that loan. Could be all 30 years, or you could refinance if the rates go down. But as long as you have that loan, it's going to be at that interest rate. Then you have adjustable rate mortgages. They typically start with a teaser rate. So for the first 3 years, 5 years, 7 years, and typically 10 years is the max, you would have a teaser rate, and that rate would be good for those first years. And then thereafter, it would adjust up and down with the market. So if we're in a great time, it might be okay. It might be staying at the same rate, or it might even adjust down. However, it could, if we're in a bad rate environment, adjust up. And that can become uncomfortable if, for example, 3 years ago, when they were in the threes, you got a 3-year ARM or adjustable rate mortgage, and now we're up in the sixes. You can see how that might be a problem depending on what those adjustments were. Now, adjustable rate mortgages do have limitations, so each adjustment can only go up and down so much, but it still is a bit of a gamble. So depends on what you think is going to happen, or in a case where you might only be living in a particular area for 3 to 5 years, that might be a really good option for you, right? You'll get that lower teaser rate, and you know you're only going to live in this condominium for 3 years, or you know you have to move in a couple of years. So that might be just fine. Or you might be perfectly willing to just refinance at any time. So those might be reasons why an adjustable rate mortgage would work really well for you. Most people opt for a fixed rate mortgage and then refinance as the rates go down. When you are in a bad rate environment and the rates are going up, you're at least in a protected position. It is really important to understand what that mortgage company has to offer. And I would reiterate that it's super important that you feel comfortable with your loan officer as you'll spend time with them while you're looking for a home, as well as while you're processing the loan. And you need to feel really comfortable, like you can trust them and that they are going to be respectful and responsive. I hope this helps. If you like this content, give me a like and a follow, and have a great day.